Bill, as I said, I follow you on Twitter. I know Adam does as well. Tell us, why do you tweet?
Oh, well, it doesn't take very long. I've had my cup. I take my cup of coffee, 1 or 2 cups, and I've got my brain working, and something comes to mind that listeners might take advantage of or be respectful of. And so, do I tweet what's exactly on my mind? Yes, I do. And in some cases, because of the 140-letter limit, it's hard to get across the message. But I enjoy tweeting.
You wrote earlier this month about a credit supernova that seems to be taking hold, and I want to just pull a quote. You wrote the following, and maybe you can explain this to the viewers. Each additional dollar of credit seems to create less and less heat. In the 1980s, it took $4 of new credit to generate $1 of real GDP. Over the last decade, it's taken $10, and since 2006, $20 to produce the same result. So we're getting less bang for our buck. What's going on here, Bill?
Well, credit has been expanding, Adam, for a long time, since actually forever, since the creation of credit, but certainly since 1971 when Nixon abandoned the gold standard and it was an available, fiat type of currency, speaking of the dollar. And during that period of time, credit, which includes corporate bonds and household debt, et cetera, has expanded from $3 trillion to now $56 trillion over that period of time. Less and less bang for that $56 trillion, certainly, because during that process, credit spreads have narrowed, interest rates have come down, and the process of real growth generation from credit expansion has almost necessarily come down as well. It's the same thing as saying that the corporations are less willing to invest in a real economy that returns lower and lower rates of return than they were back in the 70s, in which credit was less available. So as spreads compress and interest rates come down, you almost necessarily have a credit market that is less effective.
Should we be concerned about this, Bill?
Well, I think we should. At some point, the ability of capitalism to expand on the basis of credit expansion is limited. Certainly capitalism is correlated specifically to productivity and to the growth in the labor force, but that combination depends upon credit and the successful productivity of credit itself in terms of its expansion and its ability to fertilize in terms of real growth. And I think, going forward, that yes, we should be concerned about that. It's the same thing as some have suggested. Robert Gordon, for instance, in suggesting that all of the low-hanging fruit has been picked. In this case, in terms of credit, much of the gain from credit expansion has already been realized, and so we've got to look for other avenues in terms of real growth going forward.
Let me ask you about something else that concerns a lot of folks, and that's the currency wars that we're seeing begin to heat up. We've got sort of a rush to the bottom, Bill, with Japan and, of course, us printing so much currency that it's creating less value for our dollars or for yen. How much of a worry is this for you in the general scheme of things? Do you worry that we are embarking on a real currency war that could at some point get out of hand?
Well, we don't necessarily think it's a war in terms of firing bullets across borders. Each country, is operating for its own benefit. It happened in the 1930s in terms of competitive devaluations. They didn't call it currency wars back then, but these days, the currency wars are basically fought with quantitative easing and check writing and low and lower policy rates. So, is it a war? Perhaps there is competition between countries in terms of this race to the bottom, this ability to, or willingness at least, proclivity to lower their currency so that their exports and real growth will be, higher than other particular countries. There's nothing wrong with that.
But let's,
go ahead. The question I guess you ask is it dangerous? Does it have potential negatives accompanying it? And I think it does relative to inflation, to the extent that each country, the Bank of Japan, the UK, the United States, perhaps not the ECB in terms of Euroland as much, but to the extent that they're all writing checks, basically what they're doing is inflating and trying to reflate their economies. Is that a danger? It's a danger for the bond market ultimately, to the extent that inflation moves, for instance, in the U.S. to 2 to 3% potentially over the next few years. So that's the danger. It's a danger of fixed income investments relative to real assets, to gold, and to the depreciation of the currency itself.
You know, but the solution, of course, to the 1930s currency war problem, if you would, was Bretton Woods and enacting a gold standard. Do you think that there could be any room in today's world for something similar?
Well, there are certainly those at either the right or the left extremes that suggest that we should have some type of rock or foundation in terms of our ability and banks' ability to generate credit. I think that probably is true, but whether or not the country or the global economy can move back to a gold standard per se, I think that would be very difficult. What central banks need to do going forward is to maintain a semblance of conservative check writing. $1 trillion a year in terms of quantitative easing, that to me and that to the market is not really conservative. It helps to elevate asset prices and to lower interest rates, but in the long run, it's basically inflationary, in terms of its momentum. So, gold standard, let's think about a central bank standard, about central banks becoming vigilantes again, and then we'll talk about gold at some future date.